Hey, all right. How's everyone doing? So you survived. You survived day one and day two. Congratulations. Welcome to the Coliseum. It's no joke here. We're serious. We're serious about helping you guys reach your goals and change the entire trajectory of your future so you can have exactly what you want, exactly what your why is that you established on day one. Well, today, day three, I apologize in advance. Your brains are going to be a little mushy when we're done here today, but in the most amazing way. I will tell you that today you're going to be taking a boatload of notes, like a serious boatload of notes. So make sure you have plenty of paper and a pen. Stretch out your hands because, of course, you're going to have to write quickly also. But it's just going to be amazing. And I'm really excited to hear today at the live Ask Us Anything how your calls were going with the brokers and finding deals. All right, so you guys ready? Let's do it. All right, so today we are talking about two topics. I'm going to go in depth for financing, and I'm also going to talk about raising private capital. And we also have a raising private capital masterclass that we did, I want to say last summer. So anyway, that's also going to be available. I'll give you a way to get a hold of that so that you can watch that. But during the challenge, you don't need to focus a whole heck of a lot on that yet, because I want you really on the phone and building relationships to get deals coming in, to start talking to lenders that would fund and finance the primary part of the loan. And then raising private capital is what you're going to be doing to raise the rest of the funds. So that can be like next week. All right, so let's start talking about financing. Okay, so what we're going to be starting to talk about here is just literally all the foundation when it comes to financing. There is a lot to it. And the stuff we're going to be talking about today, it will almost be a continuation tomorrow, except tomorrow when we are talking about all the financial analysis, we'll be using some of these same terms, but more in the number crunching department. So you are able to determine what kind of return on investment you're going to get on a loan, but depending on what the terms of the loan are. Anyway, so we're going to lay the foundation today for financing. And then tomorrow we're going to talk about how to actually crunch numbers and how to write offers. All right, so the most typical commercial real estate financing. I just wanted to kind of at a high level talk about the main ways that you would finance a deal for commercial real estate. And so commercial real estate is anything that is 5 or more units. So when you start getting into apartments and you're talking to real estate agents, brokers, lenders, and you say, I want to get into multifamily. Well, multifamily can mean a number of things. Technically, 2 to 4 units is also multifamily. This is more than one unit. You could also say a 10 unit is a multifamily. So I want you to understand the difference and the cutoff, why it's 5 units. It really has everything to do with financing. So in the world of real estate, anything that is 1 to 4 units is considered residential. All right. And it's important for you to know that, because as you're starting to talk to professionals and they're either talking about that or asking questions, you don't want to be kind of scratching your head like, what do they mean residential? Okay, so residential is anything that's 1 to 4 units, and commercial, in this case, is anything that's 5 or more units. But even within the commercial lending space, there's multiple different types of commercial. So remember yesterday when I was showing you LoopNet and there's that big drop-down menu and it had retail, healthcare, office, multifamily, it had all these different things. Commercial financing actually applies to all of those different things. But what we're going to be focusing on for the purpose of this challenge is financing apartment buildings. And so that is a commercial loan. All right, so conventional loan is, it could be from a big bank, it could be from a local credit union. A conventional loan is more about, like, it doesn't necessarily need to be rehabbed. So a conventional loan goes very well for a stabilized purchase, or a conventional loan works if there is rehab to be done, but the dollar amount is small enough that you can fund it out of pocket without needing to go to a special kind of lender or get a special kind of loan to help finance the rehab. So conventional loan, you kind of equate that in your mind to a stabilized purchase. So in a conventional loan, you're typically going to put down somewhere between 25 and 35% as a down payment. And that is going to depend on a lot of things. It's going to depend on the bank. It's going to depend on the current operations of the building and the cash flow. It might depend on your credit score. All banks are a little bit different in how they evaluate the borrower, the deal. It's their own bylaws, like how risk averse are they? So between 25 and 35% is the most common that we see. I'm not saying that has to always be like that. We've seen every once in a while, you'll see someone get a loan that doesn't require that much of a down payment, but it's not that common to see that. So plan on 25 to 35%, most commonly 30 for a conventional loan. Bridge to perm. So a bridge to perm loan, perm is short for permanent. So that really is going to line up well when you're looking at a deal that is a value add. And especially if it's a value add deal that requires a lot of rehab. So if you go to, one of the big banks and you're talking about buying this property and you want to have more money that you can put towards rehab, they're going to be like, well, what do you mean? What do you mean it needs to be rehabbed? It's probably outside their lending guidelines, because those really big banks tend to be ultra conservative. And so if they don't have specifically a bridge to perm loan product, they're going to be like, yeah, no, I don't think so, because it's just outside of what they do. So a bridge to perm is when you're getting an initial loan that is intended to be, it's almost like getting a hard money loan and then refinancing. If you think of like the residential side, except a bridge to perm, there is no refinance. They know going in that in the beginning, it's a bridge loan. It's a temporary short-term loans, typically anywhere from 12 to 24 months, sometimes a little bit longer, so that you can stabilize the building. Once the building is stabilized, which that was your whole point in doing the value add, then it converts to a permanent loan without you having to refinance. So it saves on some of the costs. So it's a good solution if you're looking at a value add product. A portfolio loan is, you're probably not going to use that with your apartment investing, but because we're talking about commercial real estate financing, I did want to bring it up. A portfolio loan is when you're buying a portfolio of properties or refinancing, and there's more than 5 units, but they're not necessarily in the same building. So for example, let's say you have 5 duplexes. So that's really 10 units. You can get or you're buying 5 duplexes. You can get what's called a portfolio loan. And a portfolio loan is very, very similar to an apartment loan. The way that they look at the numbers, the way that they evaluate you, the way that they're looking at the debt service coverage ratio, the net operating income, the cash flow of the deal, everything the same way they're looking at it like any other real estate deal, except it's for multiple properties. So you would have one LLC that owns all of the properties that are in that loan. At least that's typically how the lender would require it. You make one payment every month, and that is for all of the properties that are under that loan. All right, so if you guys are ever looking at a portfolio, like you might be looking for an apartment building, but through your apartment building search, might find, oh, wow, I just found that there's 4 fourplexes that the same seller is selling. And that would be an opportunity to go and get a portfolio loan, because if you're buying them individually, each fourplex, it would be a residential loan because it's under 4 units, or it's 4 and under units. But if you're doing it all together, you can get a portfolio loan. All right, because a lot of people don't realize that exists. So I want you guys to be aware, because you're gonna probably see portfolios when you're talking to brokers and when you're looking at LoopNet and Crexi, because people will list on those websites a portfolio of properties they're trying to sell also. All right, another financing strategy, I don't see it as often, but it does exist, so I still want you to be aware of it, is something called an assumable loan. Now, an assumable loan is one where the original borrower, when they signed up for the loan, it was one that could be assumed. Now, it doesn't just mean you can come in and say, okay, I've taken it over. An assumable loan, you actually do have to qualify with the lender, and the lender has to say, okay. The reason you probably are not going to end up doing an assumable loan anytime in the immediate future is because in the last year, 2 years, the interest rates have gone down so much that any assumable loan, the interest rate is probably not that attractive to you. You could just go get a new loan at a much lower interest rate, assuming you could qualify. But if you're in a situation where you couldn't qualify for it, you might try to go for the assumable loan. But then again, you're going to have to qualify for that too. So if you couldn't qualify for another loan, then you probably wouldn't be able to qualify for that one either. And you might have to bring in a partner for it. But anyway, I just want you to be aware because you will once in a while see assumable loan. And if you do see that, then you want to ask questions like, well, what's the interest rate? What's the term of the loan? Like, is it going to be around for a while? Is it ending in a year? If it's ending in a short period of time, you might as well just go get your own new loan because you're going to have to refinance anyway. Okay. And then another one that's fairly common in the world of apartment investing is owner financing. So owner financing is where the seller of the property has, well, they don't have to have equity, but they typically have equity. So I'll give you an example. Like Battelle, who is a member of our mastermind, bought a 9-unit. She's about to close on her next 9-unit in a couple of weeks, but she bought her first 9-unit in September. And it was, I'm going to give you kind of guideline numbers. Let's say it was 1.6 million was the purchase price. All right. It needed a lot of rehab. It needed over $200,000 of rehab in order to get it to the condition that she wants it to do the full value add. All right. So the owner agreed. He wanted a lot of money down. And she was like, look, I only have so much capital to play with here. I need $200,000 just to renovate it. So I can't give you 700,000. And he's like, well, I want 500,000. And she's like, well, I don't have it. I don't have that much. So I'll give you 300,000. And so it was actually this back and forth. She started at 2, he started at 7, and she ended up negotiating over and over and over with him. I just made her, she was one of my coaching students, and I kept making her go back and negotiate more. But by doing that, I was like, look, don't give in so easily. He obviously wants to sell. He's gone through COVID. He's, he's a little bit on the older side, and frankly, he's tired because he's been self-managing. So keep negotiating. Anyway, so she did that, and she ended up settling on 300,000 as a down payment, which she was very comfortable with. Okay, so owner financing in that particular case, if the purchase price was 1.6 million and she put down a $300 or $300,000 down payment, that means the loan or the amount that's left that's being owner financed is 1.3 million. Okay, so owner financing is probably one of the most flexible types of financing where you're going to see all sorts of different things. And I'll give you another example in a second with Steve and Marlene and Brad and Lupe and Felicia and Debbie, all the people, a whole bunch of people in our mastermind group together to take this deal down. And that one got really creative. So I'll explain about that one in a minute. I just want you to have a picture in your mind of what's possible so that when you go out there and start talking, you know what can be done, right? Because it's already been done. It's been done even just people within our group in our mastermind very recently, as of the last couple months. Anyway, so with Battelle, it was interesting because the seller had said, look, I'm willing to owner finance it because he bought the property for like $250,000 a long time ago, but he's selling it for 1.6. He bought it for 250,000. Can you imagine what it's going to be for him? What it's going to be like for him at tax time? Like if he sold it outright and cashed out, he would get creamed by the IRS. Like he would pay out so much, and he wasn't trying to 1031 exchange it. He was just selling it outright. So that would be a really bad move for him, really, to sell it outright and get, lose a third, or maybe not a third. They're in Florida, so they don't have state taxes there, but he's going to lose a huge chunk of his gain to the IRS in the form of taxes. So by providing owner financing to Battelle, the benefit to her is obviously she didn't have to go to a bank, and the amount she put down was a lot less than it would have been had she gone to a bank. Because of the bank, she's going to put down a minimum 25, probably closer to 35%. And because of all the rehab, it would have been a challenging one to fund anyway. But the benefit to him, to the seller, is that he only gets taxed on the portion of the sale that he receives each year. So in 2020, so they bought the building in September. I think the first mortgage payment was probably due November. So let's say, I don't exactly know the numbers, but let's say that the mortgage payments were $7,500. So, and it was interest only. I'll tell you more about that in a second. So she put down 300,000 and she made a payment of, let's say, 7,500 in November and 7,500 in December. So that's 315,000. So in 2020, and I don't know if they will subtract it completely from the basis at that point. And so if he's just paying the difference, but either way, instead of paying taxes on $1.6 million of a sale, he's only having to pay taxes on $315,000 in 2020. In 2021, he'll pay taxes on just the amount he received, which will be 7,500 times 12. So it's a strategy to stretch out the time that you're paying long-term capital gains taxes, so you don't take such a hit. Anyway, and so for a lot of owners, I want you to understand that, because when you're talking to a seller or even talking to a broker, some people don't actually know that there's actually a huge benefit to the sellers of accepting seller financing. And if they don't know that, then they don't even realize that that actually could be better for the seller. All right, so some of the other parts of that were the seller had said, look, I want this to be an interest-only loan. I don't want you paying any of the principal down. So it's like, okay. But if it was a long-term buy and hold with him, we wouldn't want to do that. Like, we don't want to just pay interest. We want to be able to start paying down the loan. But he wasn't providing a 30-year loan, right? He wasn't providing a long-term loan. He said, I will give you a 5-year note. So, and you're going to pay interest only. And I want to say they agreed on something like 6%, which is higher than it would have been at a bank, but it would have been very difficult to even finance it with a bank. Plus, there would have been a lot more costs. So she paid a little bit more in interest, but with a very small amount of money for a deal this size, was able to get into the deal and avoided all of the different bank fees that there would have been, plus the impounds and all the cash you have to put up when you're dealing with a normal loan. All right, so he said, I'll give you 5 years interest only. And of course, her goal is to get the units renovated and get them performing and then refinance right away. But he was like, hold on, I don't want you to refinance right away. So he put a clause in there that basically she can't pay off the loan any earlier than 3 years. So it's just interesting. And my point of just telling you all those details is to really share with you just how broad and different every deal can be depending on the situation. So for him, he's like, he's in his 70s and he's like, look, I don't want you to pay it off. Because of course, as soon as she pays it off, he's going to get that huge tax bill. So he's like, I don't want you to pay it off. And he wants the cash flow. He wants that $7,500 a month, and he doesn't have to deal with tenants anymore. He doesn't have to deal with a building that's breaking down because he hasn't been putting money into it. He just wants to collect a paycheck for the next few years. Anyway, so that was an interesting one because she was like, oh, okay, that's fine. We could do 3 years. And at that point, she's probably going to want to refinance out because she can get a much lower rate, especially once it's stabilized. Okay, so that was an interesting one with owner financing. The other deal that one of our students just closed in November, and this is where Steve Caro, those of you who saw the interview, was the main person in the deal. He's the one who found the deal, had the relationship negotiated. And then there's several other people in the mastermind who joined him as partners in the deal, and they have, they contributed, finances, like money to the deal, and also they all have like different roles of what they're doing. But it's a value add project. And the thing that was very interesting about that is it was also owner financed. The purchase price was something around $2 million. It was like 2.1 million. And then Steve negotiated a $45,000 price reduction. So let's just call it 2 million to make it easy. The seller was like, I'm totally willing to carry the financing, but I want you to put down 500,000. So 500,000 on a $2 million purchase is 25%. So that's not too different than what you'd probably see at a bank, although a bank might require even a higher down payment on that. But here's where you can get really creative. And this was something that he was working with Kimberly, who is one of our coaches that does the one-on-one coaching in our program. And she walked him through like, look, you're going to have to spend money in the beginning because the building was almost full. It was 17 units were full. Only one was empty. But the leases are all, they're going to come up, 1 month at a time as based on their lease terms. The leases were so under market. They were so far under market. So it's going to take some time for him to get this building turned around and really cash flowing well. You need a little time to rehab the unit, then you got to market the unit, get tenants in there. So with Kimberly's help, he went back to the seller and basically negotiated for the first, I want to say the first 3 months, or maybe it's the first 6 months. There's no payments. Don't quote me on this. This is not exact, but something like the first 6 months, no payments at all. Now, there is interest, but he doesn't have to pay it. The interest is accruing. So there is an expense, and the seller is going to receive the money. But what it does is it helps him to be able to take the income from the building that's coming in from the current tenants and just put that back into the building to renovate it without having to go raise more capital. So it's really quite genius. And then I want to say the second 6 months, payments were like only 50%. And so the whole idea is it gives him a year to get the building turned around before he has to start making the full payment to the seller. So I want you to have the idea in your head that it can be very creative. And it just depends on what the needs are of the seller and what your needs are. And you find this great win-win scenario that meets everybody's needs. And sometimes it takes a lot of going back and forth. That's normal in multifamily world. Usually takes a while to negotiate a deal out. All right, but anyway, that's owner financing. A couple of other things I wanted to tell you about, and there's something called recourse and something called non-recourse. So most loans that you will ever get are going to be recourse loans. So what in the world does that even mean? A recourse loan means that you, as the borrower, are signing a personal guarantee. Okay, even if you're funding it in the name of your LLC. Okay, so let's say your LLC is the one getting the loan. It doesn't even show up on your credit report because you didn't get the loan, your LLC did. But most banks are going to want to have a human being behind the LLC that is basically raising their hand saying, I accept responsibility for this loan, because it helps them to feel like, okay, so this is a little bit less risky because, Bob here is willing to put his name on the line. Like, hey, I'm not just going to walk away from the deal if something goes wrong. I'm going to stick with it because frankly, I've signed personally. And if I default, you're coming after me. Okay. So that's what a recourse loan is. That's what most loans are. But there are also loans that are classified as non-recourse. So a non-recourse loan is a loan that is made to an entity, typically to an entity, into an LLC, that does not require a personal guarantee. So we had a portfolio loan that we did maybe, gosh, I don't know if it's been 2 years now, fairly recently, within the last 2 years. And I remember when we were going through that process with that portfolio lender, our loan guy is like, hey, just so that you know, we actually do have a non-recourse loan product. And I was like, okay, well, tell me a little bit more about that. What would be the difference? And really the main difference. So from their standpoint, when we were doing our portfolio refinance, we would have the ability to not sign personally, meaning if anything ever went wrong, we had to just kind of walk away, which we have no intention of doing. They couldn't come back to us for any kind of personal guarantee. So I was like, okay, well, I mean, overall, that's obviously always going to be ideal that you don't have a personal guarantee, but what does that loan look like? And so it was going to be, the loan is going to have a higher interest rate. Well, because this is a long-term buy and hold for us, I don't really want to have a higher interest rate. We're trying to maximize cash flow. So it was going to have a higher interest rate. Some of the terms were not really appealing. So we didn't choose to go that route. But depending on where you're at in your career and what your goals are, you might choose to do non-recourse loans. I just want you to be aware that it's a thing and is out there. Some banks have it, some don't. But it's a terminology that's common enough that you'll hear it. Where you'll hear it the most is when if you're ever purchasing a property with a self-directed IRA or 401k or something like that, where you're buying a real estate asset with your retirement funds, you're actually not allowed to sign personally on it. Like it's a prohibited transaction. And it could basically make your entire IRA what is it called? Distributable. So obviously you don't want to do that. And your IRA director would have that conversation with you, but it's important for you to know that as well. Anyway, so anytime there's a deal that is being purchased with an IRA, it has to be non-recourse because you literally cannot sign. It's almost like they consider it like intermingling personal and business, but the business being the IRA, and the IRS doesn't allow it. So all of those loans are considered non-recourse. So, and one thing I'm trying to do, we'll see whether I'm successful, but I did reach out to NASB Bank yesterday, which is North American Savings Bank, because I know that they lend on real estate non-recourse. And most of their business is IRAs. They're people buying with the IRAs. So what I'm trying to do is trying to get them on the phone and seeing if I could do an interview in the group with them, just so I could try to really extract the information so that those of you who have self-directed IRAs, or people who do and you want to partner, something like that, you have more knowledge about what it's like from the lending side so that you could start making some plans on how to best use that. So fingers crossed, we'll see how that goes. All right. So that's recourse and non-recourse. Even if you guys, I mean, literally, even if you're doing a fix and flip with a hard money lender, it's still going to be a recourse loan 99% of the time. I've heard of very small number of lenders for a fix and flip that will actually do non-recourse. So it's just the most common thing you're going to see. You're going to have to sign a personal guarantee most of the time. All right, now let's get into some important terms to understand as you're stepping further into financing. Interest rates, I'm sure you all know what interest rates are, right? It's a percentage. So if the interest rate on a loan is 5%, that means over the course of a year, okay, interest rates are always quoted in terms of annual. Okay, so in case you're new to real estate, for those of you who've been in real estate, you've been learning stuff, that's not going to be a surprise to you. But I find that when people are newer in real estate, they don't necessarily know that, right? Until you've been around, how would you know? So anytime you see an interest rate, it's always an annual interest rate. So if something was 5%, you take the loan amount. So let's say the loan amount was $1 million. The interest rate, that 5% over the course of the year, is then broken into, effectively, if it was interest only, it'd be broken into 12 equal payments, right? But if it's, let's say, a 5% interest rate on a 30-year amortization, and I'll talk about amortization in just a little bit here, then your payment will be fixed. More of your payment every month will go to interest in the beginning, and then a very small amount will go to principal. But over time, every month that you pay that balance down, that little principal balance, your new principal balance is lower, which means it's lower interest, and more of it's going to the principal. So if you ever looked at a regular like amortization schedule, you'll see each month your principal part of the payment is going up and the interest part of your payment is going down. And the payment itself is exactly the same over the course of the 30 years. All right. So anyway, interest rates can be all over the map. If you're going with like hard money, it's going to be a little bit higher. Although frankly, these days, even hard money lenders, interest rates are like exceptionally low compared to when I was new in 2003. Like they're crazy low, but I know it's just because all the interest rates are super low. But you know, I've seen interest rates even as low as lower than 3%, which is completely nuts to me. I can't believe the interest rates are that low. But you're always going to shop around when it comes to looking for financing and finding out what it is. If you are a W-2 earner and you have perfect credit and things like that, in general, you're probably going to be able to qualify for even lower interest and things like that. If you're self-employed or your credit isn't great or you have some credit blemishes, you're probably going to pay the price in terms of a higher interest rate. And this is something where it really comes in handy when you have a business partner or you have a partner that you're partnering with for the deal, and maybe they fit all the boxes. They can check all the boxes of all the things that a lender would love to see. And then you have the loan based on them, and you might both sign personally, but obviously you want to get the better loan terms. All right. So interest rate is the amount of interest you're going to pay over the course of a year on a loan. All right. Fixed versus adjustable. So a fixed rate loan. So let's say we're talking about a 30-year fixed rate loan. What that means is for the entire term of the loan, the interest rate is the same. It doesn't change. It's just the same. Like right now, if you could get a fixed interest rate, you're going to want to do that because it's unheard of how low the interest rates are right now. And so if you could fix that, lock that in for as long as possible, that's what you want to do. An adjustable rate mortgage is one where it will typically be locked for a period of time. And then it goes to an adjustable rate, which is going to be based probably on LIBOR. There's going to be some index that they have the basis of the loan on, and then it's like LIBOR plus 1% or whatever it's going to be. Okay, so adjustable means it could change year after year. Now, typically what you'll see is if someone gives you a quote and they say it's a 30-year amortization, but a 3-1 arm or 5-1 arm or 7-1 arm. And when I say like 3-1, it looks like on paper, it looks like a 3/1. All right. Or I don't know, it's slash, like that little right slash that's right below your question mark on your keyboard. All right. So 3/1 means for the first 3 years, it's fixed. And then after that, it becomes adjustable. And every year, the 1 means every year that it will adjust. Okay. So it's not like it's adjusting every month, once a year. If you have a 7-1 arm, it's fixed for the first 7 years. And then the one means it's going to adjust every year after that. Okay, so that's what fixed versus adjustable means. If you're doing a value add project, you really don't care about getting an adjustable loan because you're not going to keep it long-term anyway. You're either going to sell a building or refinance out most of the time. Okay, unless your plan is to do a value add, but then just keep it and never refinance. That would be an unusual thing to do. But if you were going to do that, then you would want to focus on a fixed rate loan. Generally speaking, you'll probably get a better interest rate with adjustable for the initial term of the loan, because the fixed rate loan from the bank standpoint, it locks them into a really low interest rate. So they're probably going to want to try to hedge some of that risk of them not being able to make money in the future because all their loan amount, all their money is tied up with your deal. So you're probably going to pay a little bit higher interest rate with fixed. And I'm not saying it has to be that case. That's usually what you're going to see, and that's realistic. So I didn't want you to be shocked if you see there's a difference. All right, so what about terms? By terms, what I mean there is like the length of the loan. So let's say it's a 30-year amortized loan. Actually, I keep saying 30-year. In apartment world, 25 years is the more realistic. 30 years is not unheard of, and 20 years comes up. 25 years is the most common. So let me adjust my language to 25 years. All right, so let's say that it's the term of the loan is 25 years. It's a 25-year fixed interest rate, fully amortized loan. That just means you're going to have the same loan for 25 years. It's something you would do for a stabilized purchase, and you know your payments are going to be exactly the same for the next 300 months, and then you'll be paid off. At the end, you'll have zero balance. All right. Those exist. What you will see more commonly, though, is it might be a 25-year amortization. And the amortization period, by the way, is also negotiable. So don't ever think just because they say this is what it is, that you can't go back and negotiate. And that's why calling multiple lenders is always good, because you can almost play off each other. They make a lot of money off the loan, so they want the loan. They want it. So make sure you're talking to multiple people, because that's a negotiating point. But anyway, let's say it's a 25-year amortization, and it's a fixed rate loan, but it has a 10-year balloon. So what that means is you're going to be making the same payment for the next 10 years as if you're going to pay it off in 25 years. But at the 10-year mark, you have to pay it off. So that either means you would have to sell the building to pay it off, or you would refinance if it was a long-term hold. All right, so that's one of the terms you'll see, which is basically a balloon payment. You might also see a 5-1 ARM with a 10-year balloon with a 25-year amortization. Like, there's all sorts of different things that you can see out there. All right. Amortization is the period of time over which you're going to pay off the loan. So in 1 to 4 family world, 30 years is very common. That's 360 months. That's the amortization. So if you pay the same payment every month for 360 months, you'd be paid off at the end. In apartments, it's probably going to be more like 25 years. Apartments are considered a little bit higher of a risk as far as assets go from the bank standpoint, not because the asset itself is risky. It's actually really, from the landlord standpoint, it's really the opposite. But from the bank standpoint, you know, if something went wrong with someone and they needed to sell a single family home or a duplex, that's not going to be that hard to sell, right? There's lots of buyers for single family homes, and there's even lots of buyers for duplexes. There's not so many buyers for a 30-unit apartment building, right? You've really narrowed the field. So from the lender's standpoint, it's a riskier asset. And so because of that, they're like, you know what? Let's stack the odds in our favor by having like a shorter amortization period, which means that they're getting paid more every month. So a shorter amortization period is going to create a higher monthly payment. Okay, so for example, if you took the same exact loan and you were going to pay it off, let's say it's $1 million, and you were going to pay it off over 25 years, your payment would be whatever that's going to be. It depends on the interest rate and everything else. But let's say you have another bank who said, well, we will give you 20 years. We'll do it amortized over 20 years. So on one side, the plus side is in 20 years, you'd be all done paying it. On the minus side is your monthly payment is going to have to go up quite a bit in order to pay off this $1 million asset 5 years early. Okay, so and neither is right or wrong. It really depends on where you're at in life. And do you need the cash flow right now? If you need the cash flow right now, you want the longest amortization possible, right? If you are like, I don't really need the cash flow, I'm just buying this for retirement. If that's the case, then you might not care as much about it being a 20-year amortization and paying more payments because frankly, maybe you're working full time and the money's nice, but you don't really need it. You're really trying to secure retirement assets. Then a 20-year amortization or even a 15-year amortization, as long as it still cash flows and it meets the debt service coverage ratio, might be just fine. Okay, so there really is almost never a right and wrong answer when it comes to this stuff. It is always just understanding how everything works and lining it up with you and your needs and your goals based on where you're at in your life and investing journey. All right, loan to value, LTV. LTV is something you're going to hear commonly. Loan to value is, for all intents and purposes, it's the percentage of the loan they're going to give you compared to the purchase price. Now, the V doesn't actually stand for purchase price, it stands for value, but the way that banks usually do it is the purchase price is the perceived value, which they're going to verify with an appraisal. So usually when they say, well, we'll give you a 75% loan to value, they're saying we will fund 75% of your purchase, but they're going to go verify that the value of the property is what you're paying for it, at least. Okay, so LTV is the percentage of the loan compared to the purchase price or the value, okay, LTV. And so LTV in apartment world is typically going to be 65 to 75%, right? And that's why the down payment is the inverse of that, 25 to 35%. Okay, so loan to value is the percentage that they're going to loan you. DSCR, and we're going to talk more about DSCR tomorrow. That stands for debt service coverage ratio. Okay, debt service coverage ratio. The debt service coverage ratio is the relationship between the net operating income, which is the revenues minus the expenses. And don't stress out. We're going to go into more depth tomorrow with DSCR, how to calculate it, what it means. But I still want you to understand how it fits into the financing side of things. So it's the net operating income compared to the annual mortgage payments. So most lenders are going to want to see that your net operating income, the money that you are left with, net in the bank, before paying your mortgage is at least 25 to 30% higher than what your mortgage payment is. Okay, and then that, for us, we call that cash flow. The difference, that 25%, 30% is cash flow. So the higher the debt service coverage ratio is, the less risky the deal is for the bank. So Jen and I, when we're running our numbers, we really prefer to have a DSCR of 1.5 to 1.6. That's our ideal. That's what we want to have. It doesn't always work out that way, but the reason, so let's say I had a 1.5 debt service coverage ratio. That means the 1 point means I'm covering 100% of the mortgage payment. The 0.5 that's after that means it's 50% above and beyond the mortgage is what I have coming in from net operating income. So it means the cash flow is higher. So how does DSCR impact the terms of the loan? Well, every lender's a little bit differently, or does things a little bit differently. But if you have a higher debt service coverage ratio, with some lenders, they'll say, okay, well, that's actually less risky for us. So in exchange, we will, whatever it is, make a longer balloon payment or give you a lower interest rate. Okay, so you always want to ask the question about DSCR and if I take it's gonna be more relevant when you guys are doing like a refinance and you're deciding how much cash to pull out if you're in the position to do that. Like with Jen and I, when we did our most recent refinance, we actually pulled out less cash than we had the opportunity to. The lender was willing to go to 75%. We chose to just refinance at 70 because we would rather leave the equity in the property and have a higher cash flow. Well, what it did is it made us have an even better debt service coverage ratio because our loan amount was smaller because we didn't pull out so much cash. So we didn't end up having as big of a loan. And because we had a higher debt service coverage ratio, we ended up with a lower interest rate, which then made the debt service coverage ratio even lower. And tomorrow, when I show you how to use the multifamily, it's just like a quick analysis tool. I'll actually show you different examples so you can see how different decisions that you make, how that impacts the finances of the deal. All right, let's talk about more terms to understand. So it's really common when you're dealing with a lender to have both points and fees. So first things first, what's a point? So 1 point is 1% of the loan. So if you're getting a loan for $1 million, 1 point would be $10,000. So it's really important as you're shopping around with different lenders that you find out like what their points and fees are, because it can make a substantial difference, especially the larger the loan, the bigger a difference, even a half a percentage makes. So, 1 point is 1%. So if you're talking about something being 1.5 points versus 1 point, and you're at $1 million price point, that's a $5,000 difference. It's significant from a cash standpoint. So that's what you want to ask about. What are their points? Fees can look like a number of different things. Every lender is different. It could be underwriting fee, legal fee, processing fee, due diligence fee. There's a lot of different things. They call them all something different. So you want to ask up front when you're talking to lenders, what kinds of fees, lender fees specifically, and third-party fees other than from the title company should I expect from the loan, right? Because again, that might help you choose one lender versus another. All right, balloon payment we talked a little bit about on the last slide. So the balloon payment is essentially when the note becomes due. So it's not super common to find a 25-year fully amortized fixed payment. Not that it's unheard of, but most of the time lenders are trying to mitigate their interest rate risk by creating a shorter term loan. So it might be amortized over 25 years, meaning the payments are going to be lower than they would if it was just a 10-year loan, amortized loan. But they might say, well, the balloon payment is due at year 10. And what that allows the bank to do is get paid back and then re-lend those funds out at what in their opinion would probably be a higher interest rate, right? So that's why they put balloon payments in effect, so that they know at some point in the future they're going to get their money back. Impounds, actually, let me talk about prepayment penalty first, because it kind of goes along with that. So it's common when you're getting a commercial loan, and actually even a loan on a regular duplex is going to have the same kind of thing. It's very common for lenders to put in place something called a prepayment penalty, and it could be on a graduated scale. So a prepayment penalty is essentially a fee that they would charge if you pay off the loan early. So if you sell the property or if you refinance the property. So basically, if they get their money back too soon, they haven't had enough opportunity to make the amount of money that they want to make, right? So they put a prepayment penalty in effect to discourage you from paying off the loan through refinance or through selling it. And if that doesn't discourage you, at least they're going to get some kind of financial compensation for it. So some loans, you'll see that there's a step down prepayment penalty. So let's say they have a 5-year prepayment penalty, but in year 1, it's 5 points. In year 2, it's 4 points. Year 3, it's 3 points. So as the loan gets further and further along, meaning they've had an opportunity to make more and more interest, the prepayment penalty will go down. And some it's just a fixed prepayment penalty. It's all different lender by lender, but these are things you need to ask about because you need to make sure it lines up with your strategy. So for example, if you're doing a stabilized purchase, right, and you're going to hold it for a long time to come, you don't really care so much about a prepayment penalty because you don't have any plans on paying it off early. Right? You're putting your down payment, you're getting a loan, and now you're going to own the property and get your cash flow. Where prepayment penalty is going to become more relevant is if you are doing a value add and you're getting a conventional loan to finance it. Maybe you're going to fund the rehab just out of pocket. So if you're getting a conventional loan, but within a couple of years, you're going to want to refinance to pull some of your capital out because you probably have raised the value of the property over those couple of years if you're doing a value add project. So maybe you want to refinance your money out. Well, if you weren't paying attention in the beginning to the loan and realizing, oh, wait, you have a 5-year prepayment penalty, you could end up paying a very, very hefty fee for refinancing. So it's something you have to pay attention to early and to make sure that you're getting the loan that makes the most sense based on what you're planning on doing with the property. Okay, impounds. So going back up, impounds is basically a deposit, but it's something that I'm going to say pretty much every lender is going to make sure that you're paying. So if you're buying an apartment building and you're getting any kind of regular bank loan, they want to know that they have it's usually at least 3 months and sometimes 6 months and sometimes 12 months, but usually like 3 to 6 months of impounds. So impounds are the property taxes and the insurance, and also sometimes, I don't know if these are not considered impounds, but it's along the same lines. It's like a reserve for capital expenditures. So what they'll do, let's say it required 3 months of impounds, or yeah. And let's say that property taxes were $12,000 a year. Okay, so if it's $12,000 of property taxes in a year, on the day that you're closing, they're going to require that you put up $3,000 for property taxes that the lender holds on to. You don't get interest on it. It's just one of those things where you have to take out cash out of your pocket and it's held by the lender. And the lender does that to help make sure that if for some reason you stopped paying, that they at least have a couple of months ahead for insurance and property taxes. So they do the same thing with insurance. They're going to calculate what is your annual insurance premium, divide it by 12, multiply it by 3 if it's a 3-month requirement, and they're going to require you bring that to closing and they're going to hold it. CapEx, or capital expenditure reserves, the lender is going to come up with some dollar amount per unit that they want held in a capital expenditures account. This is also something you're going to be paying monthly. So you're going to be paying 1/12 of your property taxes monthly, 1/12 of your insurance monthly, and 1/12 of the capital expenditures reserve that they want to have. So impounds, you have to be prepared and knowing how many months of impounds do I need so that you can be prepared with the cash when it comes time to close. And then just know your monthly payment is not just going to be the principal and interest on the loan. It's going to be principal, interest, taxes, and insurance, and CapEx. Okay, so the way that, I didn't put this term on there, but the way CapEx basically works is every month you're putting money in, right? It's through your payment. You make a payment to the bank that is principal, interest, taxes, insurance, CapEx. And it just basically builds and builds and builds. And then if something happens on your property, that would be a capital expenditure. So it doesn't mean like the toilet breaks and then you request a draw, but like say the roof goes bad, you need to replace the roof, or the fence, like something that's a more significant capital outlay. You basically go to your bank and say, okay, this is the amount of the expense. Here's the invoice. I want to draw my funds for my capital expenditure account. So they review it and then they approve it, and then they send you the funds. So it's almost like a forced savings account because it is your money. And when you pay off the loan, if there's anything left in the CapEx account, you get it. It's refunded to you. It's just the lender's way of protecting themselves in case the borrower defaults, that they have some money in reserves to take care of the property. All right. And then finally, the cash reserves requirement. This is something you want to be aware of going in and asking questions about, because when you go to close on a building, regardless of the size, it's going to go through underwriting. And underwriting is going to look at the property. They're going to look at you and they're going to say, okay, what is our risk here? Well, one of the things that helps lenders feel better about making the loan is knowing that the borrower has money in the bank. So if something goes wrong at the property, the borrower can handle it, can pay for it, not to the detriment of paying the mortgage. And that's literally all of the motivation that you'll see behind all the different things banks do. It's they don't want to be in a position where the borrower defaults and they're left holding the bag. So the more cash reserves you have, the more comfortable they are. So every lender is going to have some kind of requirement of what cash reserves they want to see. So that's one of the questions you want to ask about in advance to make sure that when it comes time to closing, you're not caught unaware, like, oh no, I didn't realize I was going to need to have $20,000 more in the bank. And maybe if you knew that, you could have made arrangements to make sure it was there. Okay, so these are some of the things that if you plan it in advance, you're not caught at the 11th hour, which is when a lot of these things tend to come up if you don't know about it. And then you don't have time to, to adjust. All right. A few more things. So when it comes to getting financing, there are mortgage brokers, aside from actual banks, right? There's mortgage brokers and mortgage bankers. And I want to explain the difference. A mortgage banker is someone who works at a bank. They are the lender. They are a direct lender. So when you're talking to them, they're giving you the rates and terms. It's for their bank. A mortgage broker is someone who, they have a lot of different lenders that they work with. And when you come to them, you say, this is the deal. These are the terms. This is me as a borrower, what I have, my credit score, et cetera. They're going to go out to all of their different lenders and they're going to look for, the couple of lenders that are going to be the absolute best fit for you and that deal. And then they're going to shop your deal to them. So they're going to give them the deal, they're going to get terms back, and then they're going to present them to you. So a mortgage broker can be a really good option if you don't have time to be calling around to a bunch of lenders. it's ideal if you can go directly to the lender because you're going to end up saving money. Mortgage brokers do have a fee that you end up paying, but the other benefit to them is, of course, you might end up with a much better deal because of the many relationships that they have and the different banks they're sending it to. So, when you're getting started, I suggest reaching out to both. Okay. Primary and secondary financing. So primary financing is going to be like the 65 to 75% of the purchase price, which should be produced by either the seller or the bank, the seller or a bank. Right. So seller financing would be the seller. Obviously, bank financing would be the bank. Now, what about that other 25 to 35%? That's the secondary financing. So you might be funding that on your own. Then we would just call it a down payment. But you might not be funding it on your own. Like if you don't have that much capital. And if you don't, then that's where you have to go into, well, how am I going to make up the difference? And that can be done through either raising private money. And that could be done either, well, it's pretty much, if you're going to do apartments, if you're raising private money and they're going to be passive investors, that's where syndication comes in. So I'm not suggesting you start with syndication. And in fact, I firmly believe that people will take a lot more action if they will just leave syndication off the table for their first deal so they can just get through a deal without all the complication of it. But if you're going to be raising private capital in a way where you're just borrowing the money or you're having investors come into the deal and all they're doing is putting in money, they have no active role, then that falls under the guidelines of syndication through the SEC. Okay, and so you have to go through an attorney, get a private placement memorandum in order to legally raise funds that way. Right, but another way to do it, and which is what we're going to be talking about a little bit more in today's presentation, is raising private capital through joint venture partnerships. All right, so with secondary financing, whether you're going to do a syndication and bring in passive investors to finance the difference, or if you're going to come in with JV partners and they're bringing in the difference, it's basically how are you solving for the problem of the difference between the purchase price plus all the other capital that you need up front in pounds and such, and what the primary financing is providing. Another way that you could do secondary financing, sometimes there could be secondary and tertiary financing, but another option for secondary financing is actually seller financing. So for example, let's say you get 70% loan from a bank, right? So you still have 30% you need to come up with. And let's say the seller is like, well, I'm willing to carry 20% second. Okay, first of all, you have to clear that with the first mortgage holder. Like the bank has to approve that. So if they do, and the seller is carrying a second for 20%, then your tertiary financing, your third level of financing would be that 10%, which same options, private money, joint venture partnership, et cetera. All right. And so when it comes to private money, some of the terminology, I want you to understand the difference. Institutional private money and relationship private money. Relationship private money is not any official term. So I just wrote that to really establish what the difference was between the two. But institutional private money would be organizations that's what they do. That's their business, private money. Hard money lenders are oftentimes calling themselves private money lenders. So sometimes when you call a private money lender and you start talking to them through their terms, you realize, oh, it's just a hard money lender. But for whatever reason, they don't want to call themselves hard money, so they call themselves private money. Another thing with private money is you'll see it advertised sometimes. People hit you up on Facebook sometimes. You have to be very careful when it comes to people reaching out to you saying, oh, I do private money loans. Because one of the things that is unfortunately just a reality is when you're looking at a deal and you just you just need money. You need money for the deal. Sometimes you'll let your guard down, or sometimes you just don't know. You don't know what you don't know. And someone who is just completely fraudulent, and there's tons of them out there, will present you with terms and you're like, oh my gosh, this would solve all of my problems, because they'll do 100% financing at 4% interest with secured by nothing. Like it's usually, if you really look deeply at it, if you don't have any kind of emotional attachment to it, which you usually will if you're in a deal, but if you have no emotional attachment, you'll be like, wait a second, this sounds too good to be true. It is. So you're never going to get that loan. What they're going to probably end up doing is saying, oh, well, you just got to pay a couple of our fees up front, or you have to get some kind of special insurance. They have lots of different ways to convince you that you need to submit money to them, or, oh, we need you to put, part of your down payment to us now, and then it'll be refunded at closing. All of those things are huge red flags. You'll never see that money again. It's very common, and they prey on new investors. So anytime you're talking to someone about private money, it just be on your absolute highest guard. And I would really truly just prefer that if you're in our mastermind, then you can just talk to Jen and I. But if not, make sure that at a minimum you're bringing it up to us at the weekly Ask Us Anything, and be prepared with like what are the terms that they're offering, so that we can just give you just some seasoned eyes on it to say, yeah, that there's nothing about that seems out of place. It sounds like it's okay, versus, oh, okay, there's some red flags, and let me tell you what they are, and let me give you some action items to take so that you can go vet this person out. Okay, so just know that's very common. Be very careful with private money that's coming off the internet. That's not like a hard money lender. All right, relationship private money is going to be people who come into your deals as joint venture partners or as passive investors. And it's people that you develop relationships with. It's just individuals, human beings, people that you network with, and that you have the same vision, and it's a good fit. Okay, so relationship private money is just the people that that you meet over time who are putting money into your deal. I know that was a boatload of information for your brains to absorb, but it's important that you understand everything that I've taught, because it's all part of the business, right? And it might seem like a lot right now. I guarantee you start getting into it, a lot of this is going to seem very simple very quickly. And how you're going to make that happen is by actually starting to have conversations with brokers. So with like mortgage brokers, mortgage bankers, basically commercial lenders. So what I want to talk about next is, how do you find them? Because if you've already looked at the homework, then you already know what's coming, right? So let's talk about where you're going to find commercial lenders. All right, well, referrals is always going to be your number one source, your best leads. So you could get referrals from commercial real estate agents, real estate brokers, commercial property managers. So if you are looking into a market and you're building your team, you're talking to a property manager, they might have referrals to commercial lenders. Other investors who are also apartment investors who've closed deals will probably be able to point you in the direction of commercial lenders. Another place to find them is just Google, like literally going to Google and putting commercial lenders in, and then whatever the city that you're looking to find lenders in. Right. Another place that you can find commercial lenders is in real estate related Facebook groups. So I say REI. Anytime you see REI, that means real estate investing. So real estate investing related Facebook groups. So a lot of agents, brokers, anybody who would be a service professional for real estate investors are usually going to join the same kind of groups that you're in. And you might be in there for networking, for information, for learning and growing. They're there to try to build a relationship with you so that when you do need whatever service they offer, they have the opportunity to maybe get your business. All right. So by going into real estate related Facebook groups and just being active and looking at the posts, what we do like in our group, and every group is going to be a little bit different, but in our group, if you go to the units, actually Jen just created it this way so that it's easier to find. But anyway, if you go to unit 6 in our units section, you're going to see a post that's basically for the purpose of networking. So it's titled Realtor, Broker, Investor Networking Thread. And you can go there and you can, if you need a lender, you can post that. If you are a lender, you can post that. Like the whole point is to have like a single place for people to go to be able to network. So you can go into units and comment there and look at previous comments. And that would be a great place to find people as well. But every group is going to have just their own style of and way of doing things. Oh, another thing I was thinking is in our group, so even though you're not going to see individual posts from lenders, what I see a lot of lenders doing, which is smart, is when somebody posts a question about a property or financing or anything, I'll oftentimes see a lender or two comment on that person's post and say, oh, well, we have financing options for that, or something like that. So just as you're getting involved in real estate investing related groups, like pay attention and look for that. And when you see someone that looks like, oh, that might be a commercial lender, reach out to them and find out what they're about. Do be careful. Like I said earlier, do be careful about reaching out to anyone who claims to be a private money lender. And there are ones out there that are legit, but there's just so many that are scamming, and they love to, hide in Facebook groups and, and kind of try to stay under the radar of the admins by just commenting. So, keep your eyes open for that as well. All right, so that's real estate related Facebook groups. So of course, what you're going to want to do is you're going to want to join some groups in addition to ours, and just start getting involved and picking up referrals that way. Next topic, we're going to cover this somewhat briefly, but I'm going to give you some really good visuals. And then when we're done, we actually had a masterclass that was called Raising Private Money. And if you message our admin, Jen Stacy admin, and send a private message basically saying, can I get the Raising Private Money masterclass? She'll go ahead and get that to you. Anyway, so I'm going to cover it fairly briefly because right now this isn't the thing that you need in order to start taking action, but it is something you will need in order to close a deal. So I want to touch on it so that you at least have a background, you have an idea of what I'm talking about, and also some of the steps you can take right now to start really setting yourself up well to continue building upon this once the challenge is done. So let me lay a little bit of foundation. So with raising private capital, there's really two primary ways, right? You can either do through syndication, which would be you're raising private capital through passive investors, where all they do is just basically give you their money or give money to the deal, and you are the one that's active, but they don't have any active role in the deal, okay? And if you're doing syndication, you're raising money that way, it's not uncommon to have a lot of different investors that might be investing into a deal. So it could be a whole bunch of different investors. So it's just something to be aware of. The complication of it is more just understanding all the ins and outs of the SEC compliance that's required if you decide to go that route at some point. Like I said, not for your first deal. For your first deal, just do a deal that's like fairly straightforward and simple so that you can get one done. That first one is so important. It opens up doors that you can't even fathom. So you just need to get one done. But later down the line, as you're doing bigger and bigger deals, you might find that it's necessary to do a syndication because the amount of capital you have to raise. So you're going to want to make sure that you get educated on that specifically, because the last thing you want is for the Securities and Exchange Commission to be breathing down your neck because you didn't set it up correctly. And it's never really an issue unless one of your investors complains. But then it's big trouble. So you don't want to do that. The other thing about syndication is that there is a fair amount of cost involved in doing a syndication because you have to hire an attorney, a specialized attorney, to come up with the private placement memorandum, which is the document that you would give to potential investors that explains all about the deal, the risks, the projected returns, etc. And depending on how you're advertising or how you're trying to attract private investors, there's a lot of different rules about like what regulation you have to follow based on how you're marketing for deals and what level of investor they have to be. They have to be accredited investor. Can they just be sophisticated? And how many sophisticated investors are allowed? Like it's very complicated. Anyway, but that will be an option for you once you are a little bit further down the line. All right, so when you're new and you don't have the funds to fund your deal, the way I would love to see you go so that you can actually get going, get your first apartment building, is joint venture. So with a joint venture, it's the same kind of thing. You're bringing other people into your deal. You don't want to have a whole bunch of people. Okay, this is not something where you're trying to bring in 15 people into your deal. Ideally, maybe 2 or 3. But the whole structure of it is that everybody that's in this joint venture project has some kind of role. It doesn't have to be a big role, but they have to have a defined role, and you're going to want to have that role spelled out in the operating agreement of the LLC. So in a joint venture, everybody who's an owner of the joint venture is going to be a member of the LLC. The LLC owns the building. Okay, and then everybody who's a member of the LLC has some kind of active role. I mean, one person's role might be taking the board minutes. Someone else might be doing the tax return or facilitating that. Like, doesn't have to be big, but it has to be defined. Okay, otherwise, if you're a passive investor, then technically it needs to be through the SEC and doing a private placement memorandum. All right, so with the Raising Private Money Masterclass, like I mentioned, message our admin, Jen Stacy admin. All of you probably have been in contact with her at some point because that was part of the instructions from day one. And then she can get you the link to Messenger. Facebook they're not too friendly on us sending out links to people that haven't contacted us first, and they'll like restrict our account because we can't send anything, can't comment. Like it's ridiculous. Like we always have to figure out like how to work around it. The funny thing is, because we are experienced real estate investors, we are very accustomed to roadblock after roadblock after roadblock, challenge after challenge after challenge being thrown up in our face. And you always have to figure out a way over it, under it, around it, or through it if you want to succeed. It's called being creative. So this is part of us being creative, is making sure you guys message our admin, because then that opens up the messenger conversation for her to be able to send you the link. Anyway, all right, so message her if you want to get a copy of that Raising Private Money Masterclass. All right, so now let's talk about, with raising private capital, the relationship building side of it. Because if you're going to be attracting joint venture partners or private money or anything like that, it is 100% about relationship building. And that is something that does take time. So you need to start, even if you don't have plans to buy something right now, although I think a lot of you absolutely want to get going right now. Even if you don't plan on buying something right now, there's certain things that you can and should be doing now to start laying the foundation that's going to turn into partners later down the line. Okay, so you always want to be getting the word out about what you're doing. So if you think of Facebook as, instead of you thinking of it as the place you go and it's for your social media and for keeping up with family, which it can be all of that. But if you start to look at your own personal Facebook profile as a marketing opportunity, you're probably going to be more strategic about the things that you post, right? So I'm going to give you some visuals on this. Your personal Facebook profile, if it doesn't have anything at all about real estate investing, then nobody in your network or your friends are going to have any idea what you're doing. And the reality is, most people, when they're starting off in real estate, it's their immediate circle of influence that usually ends up producing that JV partner or partners that end up funding the deal. So you don't want to hide. Okay, you don't want to hide that you're doing real estate investing. The only exception to that is, I understand if you have a job where if they found out you're doing that, it would cause some kind of problem, then, then I get it. Then maybe make up a screen name. I'm just kidding. Well, not really, but do whatever you can. If you really can't do it, then that's a different thing. And it's going to be a little bit more challenging, but if you're not restricted, I want you to start posting things that are related to real estate on your personal profile. It doesn't mean you need to stop posting about your family and your kids or whatever else you're doing. I mean, Jen and I, you'll see, because if we go through different things, when we're about to go into acquisition mode, you're going to see like everything we're posting is going to be apartment buildings. Hey, we're checking out this one. We'll be posting that over and over and over. We're not in acquisition mode 365 days out of the year. We usually buy something or a portfolio or a group of properties, and we work through them. We take a little break, then we go into buying mode again. Then we go into stabilization mode, we take a little break, buying mode, etc. So we go through kind of these ebbs and flows, but we will always use our personal profile to attract the type of attention that we're looking for. So for example, right now, if you went to either mine or Jen's personal Facebook profile, probably what you're going to see is something related to the challenge. Well, why is that? So that people who we're friends with on Facebook go, oh, wait, I didn't realize I could do a free apartment challenge. I didn't know that. Well, if we were not using Facebook as a marketing platform to let people know, hey, we're doing this, then there's probably all sorts of people, probably even many of you, who would never have had an opportunity to come and learn this. But this is what we're doing, and we're using our personal page to help get the word out. It's the same thing when you're starting to lay a foundation and attract private money and partners, is you want people to go to your page and go, oh, okay, I see. He's into real estate or she's into real estate. Cool. But if every one of your posts is, it's not real estate related, nobody would have any idea. Okay, so I'm going to give you some examples in just a minute for some of our students. The other thing that you can do as far as getting the word out is doing strategic posts in groups. And it of course depends on the group. Some groups allow you to post, other ones do not. You can use the same type of post in groups as you use on your personal profile. What you're never doing is you're never saying, hey, who wants to make 12% interest on their money? Like, you can't do things like that. It's not legal for you to raise funds that way. But you can certainly have a conversation with someone, but how do you even start the conversation if they don't know you're in real estate, right? So this is what I want to show you in just a minute. And then I'll go back to and talk about the real estate related groups in just a moment. All right, so this is a perfect example of what I mean. So this is Bart, he's in our mastermind. This is on his personal page, which he could take this exact same post and put it in any number of groups that allow people to post. But basically he's just saying, just went under contract on this 4-unit property in Indianapolis, hashtag investor life. So he isn't saying there what he's specifically looking for. Maybe he's wholesaling it. Maybe he's just buying it. And maybe he's looking for a partner. Now, I happen to know, because he's in the mastermind and we, discuss these things, I know that he's looking for a partner because it's a cash flow monster. At least initially, looking at the numbers, it looks like it cash flows very well. And he said, he was originally going to do wholesaling, but he's like, you know what? I don't want to wholesale this one. I want to own it. So now he's looking for a partner. Now you can't tell by looking at this post that that's what he's trying to do, right? And that's the whole idea. But look at how many comments it got, and look at how many likes, loves, and open mouth eyeball faces it got. So Natasha, Marlene, and 66 others. I mean, 68 people clicked on something. So at least 68 people saw that and thought something of it enough to click on their reaction, but 30 comments. So, and I don't know what the comments are because I didn't click on it to go look, but usually in a post like that, you probably have some of Bart's family or friends being like, wait, what? Are you moving? That's a really common one. Are you moving? Especially if they don't know you're looking to do real estate investing and they've never heard of remote investing. That's the first thing that they're going to ask. But it allows you to basically open up the conversation. Like, no, I'm not moving. I'm investing in real estate, but I do it remotely. Anyway, but for people that are like, oh my gosh, that's amazing. I want to do that someday. That opens up the opportunity for him to now engage in dialogue with that person. Like, well, hey, I'm actually looking for a partner on this deal. I'm looking for someone who can, basically fund the down payment and the closing costs and basically be my capital partner. And, and the one that would qualify for the loan. And I'll handle all the stuff, but we could basically joint venture on this. So if Bart never posted that and he's kind of keeping it on the low that he's investing in real estate, he's going to miss out on all sorts of opportunities for people to reach out to him and go, oh, hold on a second. Wait, what is this? A 4-unit? Man, I've always wanted to own real estate or always wanted to own multifamily, or tell me more about it. Okay, so he's inviting people to basically comment or reach out to him in Messenger. If they comment and it seems like, oh, that might be somebody who I should have a further conversation with, he can then reach out to them in Messenger and say, hey, let's have a conversation about this. Or, hey, I'm actually looking for a partner. Can I send you my investor packet? All right. So this is a prime example of what I'm talking about. And then again, you could put this exact same thing into any of the real estate groups. And then same thing, you're not necessarily asking for anything, but as people comment, you can engage with them and potentially turn that into a partner. All right. So this is another example. Now, Cami is also in our mastermind. And so I think she must have been posting it from her phone because it looks like it's a picture from the phone and then the property's a little bit further down. But one of the things I will always encourage people to do when they're looking to start networking, raising private capital, like finding partners, and even if you're wholesaling, is start getting it out there that you're doing real estate. So start defining yourself more as a real estate investor instead of just a bunch of random different stuff that might be on your Facebook group. So on your Facebook page, sorry. So in the first one, they're both January 14th. And that was the day she made 2 offers. So the first one was, I'm really excited about the offers I put out this week. Here's one. And she put a picture of it. And then another one was, I put out another offer on this super cute duplex, hashtag fingers crossed, and then put a picture of it. So both of those posts got engagement and people were commenting. So that gives her the opportunity to now go back and, have conversations with anyone who seems like, okay, that might be a potential, well, in this case, or a potential partner, money partner, or a potential wholesale buyer. Now, in this case, she actually got it under contract. So this was the next post, or it was later, officially have this baby under contract. Let the due diligence begin. All right, so same thing, look at how many comments there are. And if you look at it, man, this is cute. Like this is like an adorable duplex. So I was telling you, like, especially if it's a good looking property or something that's going to catch people's attention, use the picture, like use a visual. People are more attracted when there's some kind of picture to look at and there's, some words. But if it's just like super wordy text, people just pass by. It's we don't have the attention span for long written things anymore. So a picture with some brief verbiage gets a lot of people's attention. So if you look down at the bottom, you got Jen, Natasha, and 79 others who have made some kind of reaction. That means 81 people have at a minimum seen this and expressed some kind of like, love, or shocked face. All right. And then the 33 comments that basically creates it open for Cami and Leroy to go through and kind of look at, are there any there that are potential partners or buyers? This particular one, she ended up deciding to wholesale it. And actually, this is just, and we were just talking about this last night. So she's preparing to wholesale it, getting her investor packet ready and everything else. And now she had a heads up as of January 14th on who might be interested in that. All right. So this is another thing you could put in a Facebook group. This is a great example because, you guys aren't necessarily making offers yet, right? I understand during the challenge, not making offers yet, but you are looking at deals, right? Just from yesterday's homework, you should have found some deals. And even if you just found them on LoopNet, like there's apartment buildings. So Vandy and Crystal, I'm not sure who the 8 others are, probably other people in our mastermind, but Vandy is a member of our mastermind. And back in November, she posted, I'm going to buy an apartment complex one day. Oh, and investing with someone is also ownership. And then, so her whole point was, hey, investing with someone is also ownership. She's like, hey, who wants to invest with me? Because that means you'll be an apartment owner too. So it's kind of a roundabout way of being like, hey, I'm looking for a partner potentially. I'm not positive that that's what her intent was, but that is the way it comes across. And look at the number of comments and look at the number of reactions. Jen, Natasha, and 132 others, 134 reactions to this post, 93 comments. All right. And she wasn't like making the offer on it. She just posted a picture of any random apartment building and said, this is my goal. This is what I'm doing. And 93 people were commenting on it. And I'm sure out of that 93 people, there's probably a handful of people that she could follow up and have conversations with about partnering up and doing a deal together. And then this one just happened. Same thing, January 14th. This is from Tajane, also in our mastermind. And so she posted a picture of the building, because again, people like pictures, and said, submitted an LOI, which is letter of intent. It's the way we do offers for apartment buildings. Submitted an LOI on this beauty. It's only a matter of time. Hashtag mine, hashtag REI, fingers crossed. Okay, so in this case, she did submit an LOI. What I tell my students is, look, as you're going through the different stages of the deal, post where you're at in the deal, because people are following you. People are paying attention. Like, what are you doing? Oh, you made an offer? Oh, wow. That sounds scary. That's cool. Oh my gosh, you got an acceptance? Oh, wow. Oh my gosh, you're in due diligence? Ooh, what's that like? And so you're, especially people who don't reach out the first time, by you posting every couple of days with any kind of status update with either the same picture or ideally a different picture, especially if it's about kind of a different topic, it just keeps people engaged with what you're doing. Real estate investing related groups. Like this is a place, or these are places where you can do networking and building relationships. So like, what does that even mean? If you're in a real estate investing related group, like our group, for example, anybody who comes to the multifamily real estate investing group is either someone who's interested in investing, someone who is already investing, or it could be a service provider, right? So you talk about oh gosh, what is it called? Target rich environment. It's a target rich environment, right? So if you want to be networking with people who are interested in what you're interested in, and you're taking the time to go through this challenge and do all the learning and getting educated, there's a lot of people who are really interested, but they don't have the time, or they don't have the desire to go do all the learning, but they do have capital. And you're a great fit for each other, right? So what you want to do in those groups is, part of building relationships is going into the group and, is commenting on people's posts. Probably a lot of the stuff you're already doing for the challenge. And I know you're doing it to get, to get engagement points, which is cool, but that's the same thing you want to be doing anyway. So it's commenting on people's thing, adding value, because as you get further and further along in your journey, there's going to be all sorts of things that 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 can be helpful to someone else who's newer in their journey. So adding value where you can, or encouraging someone, or just saying, hey, that's a great question. I'm kind of curious too. And it just gets your name out there. And if you pay attention to what some of the other comments are, stuff like that, if you see other people who you feel like, kind of vibe with them, I like their approach and their style is similar to mine, I'd like to get to know them better. Then what you can do is send that person a friend request and send them a message in Messenger and basically connect with them outside the group. And just, you're trying to find out more about them. Like, what's their experience in real estate? What are they looking to do in real estate? And just start making connections, right, with people. And this is, you could really do this anywhere. You can almost thank COVID for creating a situation where everybody is super comfortable doing stuff online. In the old days, 2019 and prior, we used to be able to go to, real estate investing clubs, and that would be a place to network. In 2020 kind of wiped that out. And, I don't know when that's going to all open back up. But if you can't network in person, well, certainly Facebook and LinkedIn and even Instagram create environments where you can still network with other people who have similar interests to you and where you might be a good fit. And it's interesting because even within our own mastermind, group, when we have our Zoom calls, which is every week, everybody is on video, and none of the people in our group have ever met each other in person. Maybe like a rare exception, but generally nobody actually knows each other in person. But I will guarantee you, if you talk to any number of our mastermind students who have been in for anything more than, just a short period of time, they're going to say, oh no, I absolutely feel like I know them. I do know them. That's part of how, when Steve was raising funds for the 18 unit in Miami, that's part of how he got other investors to come into the deal. Why? Because they knew him, but they'd never met him in person. But it doesn't matter anymore. Like, everybody in the world at this point is used to doing things a different way over Zoom, right? So hopefully Zoom continues all their security and stuff to make it that we can always meet on Zoom. But that's really the way it happens. That's why, Marlene and Brad, when they were, they were working on their own apartment building, deals, making offers, doing due diligence and stuff. When Steve's deal came up and there was an opportunity to invest with him, they were like, well, geez, it's a great deal. And we already know Steve. And, same with Debbie and Felicia, same with Lupe. And that is why there's multiple people in our mastermind that are all in the same deal, because they have built a relationship just by being in a mastermind together and showing up and being a part of each other's journey and being there to hear what's the challenge? Well, what are you trying to do right now? Oh, you're closing on that deal. Oh, what problem came up at closing? Oh no, what are you going to do? And hearing me coach them through it and seeing their reaction and just watching other people go through the journey, like, it creates a bond and allows you to feel like you know them. That's what you're going to use the Facebook groups and building relationships to do, to kind of create a sense of community, so that when you do get to the point where you have deals, you have people that you can go, hey, are you interested in partnering up on this deal at all? And it's not like it's a cold call or awkward. All right. So I hope that makes sense. All right. So, this is, I guess what I was just talking about, but this is a little bit more specific. Okay. So with the real estate related groups, you want to get involved. So you're going to like and comment on posts. I know that sounds kind of funny, but the like and comment, or love and comment, or give a hug or whatever, there's some kind of reaction. First notifies that person that, hey, somebody liked your post or liked your comment. And then actually comment on it. Like, hey, that was awesome. Or, oh, hey, what I've done in the past is this. I hope that helps. Be positive and encouraging. Here's what I'm going to tell you. People like to be around people who are positive, who are enthusiastic, who are not Debbie Downers and totally negative. So, but I also recognize that some people's personality is just more like that. Like, I naturally go towards, looking at the glass half empty, and it's almost like you can't help it. You can't help it. So if you have that personality, you're going to almost have to step into the role of an actor and pretend you're really outgoing and happy and excited for people, because people don't want to be around people who just poke holes in everything they're doing. Oh, well, you could have done that better. Instead of like just being encouraging, be positive. When you're doing that, it will make people want to be around you more. And if you already have that natural, positive, encouraging vibe, and that's a very natural thing for you, cool, just keep doing that. But generally speaking, don't be the person that comes into any group and starts, bad mouthing anything or talking about how any specific thing is so horrible, so bad. Be always solutions oriented. So even if there is a problem, it's like, yeah, I ran into that once. Here's some of the things that we did to get through it. Instead of being, oh my gosh, I know, it's just so awful. Okay, so positive, encouraging. So you're going to send friend requests to people that you feel like, oh, I feel like I would be able to vibe with them, and then connect in Messenger. So the whole goal is to get to know people. What is their experience? Like, what have they done in real estate so far? And especially if they haven't done anything or they haven't done a whole lot, and you're looking to something bigger, that might be a good potential partner if they have funds, right? So what are they looking for? So what kind of deals are they looking for to get into? And just assessing, are they a potential JV partner? And broaching that subject. And you don't have to have a deal to do that. You could just say, hey, I'm, one of the things I'm kind of keeping an eye out for is partners. I'm going to be making offers on apartment buildings, 10 to 20 units, 5 to 10 units, 30 to 40 units, whatever, however many units you're going to be making offers on. And, I'll be looking for a couple people who could, basically joint venture. And is that something you might be interested in? It could be super casual, and don't freak out. It's no big deal. And it might be that you're able to provide for them a solution that they really hadn't considered before. And it's really a win-win because you need the partner and they need somewhere to put their money to get a good return. All right, so I'm about to go through the homework. I want to remind you, today is the opportunity to ask us questions in the challenge. Okay. Sometimes people will send us like individual messages to Jen and I asking for real estate advice and things like that. And as much as I want to be able to help everyone, there's just a reality of time. And we run a coaching business. We coach our students. We run 2 masterminds. We have all of our own real estate investing and 4 kids. Our life is exceptionally busy. So we don't really have the bandwidth to be answering questions. Like when people message us, we just don't have the bandwidth to be going back and forth and giving advice. So what Jen and I decided, this has been probably 6 months ago, is that we would just set aside time every week for, however long it is, it's usually about half hour to an hour, to just be live and let people ask us questions about real estate investing. It could be about your deal. It could just be about a general question. So you had homework last night and you have homework today, both of which lend themselves very well to you probably having questions, like you talking to the brokers and the agents, maybe talking to lenders, and they might ask you a question and you're like, oh crap, I don't know how to answer that question. What am I going to do? Right? Well, get on the live Ask Us Anything and we'll advise you. So anyway, it's a perfect opportunity where we do it every week, but right now in the challenge, while everything is fresh on your mind, I'd love for you to be there, ask questions. Even if you don't have questions, I would be shocked if you don't, but even if you don't have any questions, just getting on there and hearing other people's questions will oftentimes make you go, oh my God, I didn't even think about that. Thank goodness they asked that question. So we've gotten a lot of exceptionally good feedback about those Ask Us Anything sessions. So, and it's your time. People in our mastermind get access to it all the time, right? They get access to us a lot because they're in our mastermind group. But outside of our mastermind group, we don't have the bandwidth, but we're there for you. Okay. Every Wednesday, 4 p.m. Pacific, 7 p.m. Eastern. And it's just right here on the Facebook group. So you just come on in, it'll start. Sometimes it's 4:01 because, some kid decided at the last minute they needed to ask us a question at 3:59 and 50 seconds. So, but anyway, we'll always be there within 4-ish. Okay. And I can't promise anything as far as what is or is not going to be appropriate in the things that we say. So, because you know who the other half of Jen and Stacy are, right? I'm Stacy. Jen, she's a wild card. She's sitting here next to me and she can't even say anything. She knows she's the wild card between us.
Why fight it?
What she says, oh, why fight it? So, I just warn you ahead of time. So if you're super conservative, well, we have so much to teach you that I think you're just going to have to put aside your conservative ways and come learn anyway. But, if she drums a drops an F-bomb or says something wildly inappropriate that everybody will seriously crack up at because she's so funny, I'm just giving you a heads up. So you got to have some thick skin here because we have a good time. All right, so we look forward to seeing you guys later today with that. All right, let's hit your homework. First things first. Number 1, make a list of 5 or more commercial lenders. Okay, I showed you how to find them. Go find them, put them on your list. Talk to at least 2 commercial lenders and record results. So yesterday we had several people saying, well, where's the script? And I realized in the homework, I probably wrote, call and practice your script. I didn't mean like a specific word for word script. If we gave everybody in the challenge the same script, it would be so awkward because we'd have 300 people all at once, potentially calling the same people and saying things word for word. You never want to do that, and we would never do that to you. So what we mean is take the information that you learned in the training today and call and ask some questions. And so with the commercial lenders, you can, it's going to depend on what you're buying. So are you looking for 5 to 10 units, 10 to 20, whatever, what you would have established yesterday before calling your real estate brokers. So it's taking that same information and basically just call them saying, I'm just getting started on doing apartment investing. And as I'm talking to agents and stuff, I want to have a realistic idea of what's available from a funding standpoint. And they're going to probably say, okay, well, what are you looking at? And so that's where your strategy comes in from yesterday's lesson. So you can say, I'm looking for stabilized apartment buildings that are, 5 to 10 units, 10 to 20 units, whatever you had already established. Okay. Or I'm looking for value add apartment buildings that are, between 20 and 40 units. So, and it's just a conversation back and forth. And trust me, keep in mind that the commercial lenders, they're getting paid to be there. Like don't put them on a pedestal and create like fear around giving them a call. Like they don't make money if they don't have clients. You're a potential client. Okay. So keep that in mind when you're having conversations and just give yourself some grace to be in the learning curve. I would never tell a realtor that you're new. You'd always say, oh, my partners and I. You could say my partners have a lot of experience. With the lenders, this is the case even if you're talking to hard money lenders. With lenders, there's really no value in you presenting yourself as anything other than what you are. And here's why. Like if you're new, there's no value in saying, oh yeah, I've done 20 deals. Because when you apply for a loan, that's going to come out. You have to provide them with basically your portfolio, your real estate owned. And if you don't have any, but their original conversation notes indicated you had 20 deals, everything's going to fall apart. Plus, the rates and terms that you get quoted are going to be different when you are new compared to when you have a whole bunch of deals under your belt, because as you do more and more deals, it's less risky to lend to you. And so you're probably going to get better terms. So what you don't want to do is get information from the commercial lender. Maybe they say, oh yeah, you could do a 75% LTV. And then you actually go to get a loan and they say, oh, this is your first deal. Oh, okay. Well, in that case, we can't lend more than 65% because you're new. And I'm not saying that's what it is. I'm giving you an example that I totally made up. Okay. So there's nothing around that, but it could be, there's a number of things that could change depending on your experience. So just be whatever. And if you've bought, 8 units so far and you have like 4 duplexes, then say that. Just tell them wherever you're at, but you say, but I'm moving into apartments and this is what I'm looking for. And I want to know like what's realistic. I want to know like what do you guys have to offer and what is it like to work with you, and what loan to value do you lend on? You could just literally go to your notes in the presentation and ask some of the questions. What kind of loans do you do? What kind of loan to value? What kind of amortization? What kind of terms do you offer? Okay, and then record your results. All right, I also want you to join 2 real estate investing related Facebook groups other than ours. Okay, so get out there and join a couple of groups. The thing with Facebook groups is some of them you get accepted right away and some of them you have to wait for someone to approve you. And because I know that sometimes that doesn't happen right away, this next number 4, if you want to use our Facebook group, the multifamily real estate investing Facebook group for this next part, that's fine. And actually you probably should anyway, because it will help you with your engagement numbers if you're participating in the scholarship contest. Okay, so here's what I want you to do. I want you to find 2 posts and I want you to like it or love it or whatever, in some way respond, comment on it, something positive, encouraging, and send that person a friend request, right? And then send them a private message in Messenger. Hey, I saw your post in the multifamily investing group, and then whatever. You have to pick, come up with something that's relevant. Like, hey, I'd love to get to know you a little bit better and kind of find out what you're looking to do. This is what I'm looking to do. And just connect. And some people might not respond because if you're not already friends with them, it might go into their message requests. And some people don't even know that that's a thing, that there's this other inbox that exists. But there is. So if they don't respond, don't worry about it. I'm only having you do 2 because I want you to just get the experience of doing it. Because once you've done it once, you're like, oh, I could do that over and over. But you want to do this like every day, 5 days a week, several posts, if you are actively trying to start networking and potentially finding partners for deals. Okay. Number 5 homework. On your personal profile, I want you to make a post with a picture of an apartment building, which you could get from LoopNet, or if you got any deals from realtors, but basically a picture of an apartment building. And I want you to make some kind of post about it. It doesn't have to be like, hey, who wants a joint venture on me? Nothing like that. Just the whole point is for you to let people know what you're up to, what you're doing. So this is an example. If you want to use it word for word, go ahead. It's okay. I would love it if you would come up with some different words that are yours, but I know some of you lack creativity, as do I. So I get it. So if you can't come up with something to say, then you can go ahead and post that. But do a profile, personal profile post with a picture of the apartment building. All right. And another thing, I actually didn't talk about it previously, but let me just mention it right now. As you're doing things like that, and you're starting to have your personal profile have more real estate stuff, as you start sending out more and more friend requests, you don't want to get crazy and send out too many at a time, because Facebook apparently doesn't like that and will stop you from being able to send out more. But as you're sending out friend requests to people and they're like, well, who is this? And they go over to your page and they see, oh, okay. Oh, got it. Oh, wow. That's cool. They're doing something in apartments. Cool. Well, I'm interested in real estate. And so there's a higher chance that they're going to then accept the friend request. And now all of a sudden your message will show up in their inbox. So it's just a great way to highlight what you're doing. But sending friend requests out to people who are in real estate already is a great way to continue to attract people who are potential partners for you. All right. And then the 2 extra credit things are: 1, follow us on Instagram. We are Warriors of Wealth on Instagram. That's 3 points. The other is going to the Warriors of Wealth business page. And the link is in your tally sheet, your scoring sheet. Go to the Warriors of Wealth business page, follow us, and leave a review about what was your favorite part of the 5-day challenge. Okay, and that will be worth 7 points. I think somebody who was trying to do extra credit ahead of time on Monday mentioned that because they had already left a review on the page, that option wasn't there. So if that's the case, I still want you to be able to qualify for points. If that's the case, I almost want to have you take a screenshot of your last one and put that in the homework. And ideally, you'd be able to put a new one, because we want to get more words out about this 5-day challenge. But if you already did it and it won't let you post another one or post something on the page, just take a screenshot, include that in your homework. All right. You guys have a busy day ahead. I told you going in, you're going to work your ass off. Oh, I did say it. You're going to work your $$ off. But look at how much action you're going to take, and look at how much momentum you're going to create as a result of it. It's totally awesome. All right. So tomorrow, where's my picture? Oh, there it is. Okay. So tomorrow's awesome. I know these are long days. We just have so much to teach you. Tomorrow, we are going to go into analyzing deals, and then making offers. And on top of that, Jen is going to come in and just rock your guys' world. In the last challenge, that was some people's favorite part of the entire challenge, was when Jen came in on day 4 and started talking about how do you structure your quarters, your months, your weeks, your days to get the results that you want to get, and about mindset, and just really how to make it happen. Because it doesn't matter how much I could teach you every technical thing in the world about real estate investing. But if you don't have your mind right, if you don't know how to stay organized, if you don't know how to kind of pull it all together, like mentally and as a person, like how do I balance it all the technical stuff doesn't make any difference at all because you're just simply not going to be able to do it. So tomorrow's section that's after the analyzing deals and making offers is it's going to probably even mean even more to your success than all this other stuff we've been talking about. But you need the technical stuff in order to actually do it, but you got to have your mind right and you got to know how to organize your day and your life in order to make this happen too. So anyway, we have just an absolute kick booty day tomorrow. Can't even wait. You guys are amazing. I look forward to seeing you in a few hours for the Ask Us Anything. So go to work, get your homework done, bring any questions, and we will see you tomorrow, same time, same place. Have a good one.